PE and PEG ratios. What are these? Well, when in doubt, if you don't know what this is, I mean, it's price to earnings, price divided by earnings. It's not hard to memorize these ones. This is PEG, price earnings growth, right? Price earnings growth. The PE ratio is the one that's most widely used. This is just the PE ratio divided by the growth. If we have, right, what is price to sales, it's price divided by sales, stock price divided by sales per share. If you get confused with ratios, just kind of try to think about them a little bit. PE ratio, definitely memorize it. Have it as a part of your arsenal that you can pull out if a question asks. Well, earnings per share, right? That is going to be net income divided by number of common shares outstanding. Very much something we cover in FAR in depth. But it's good to know here, and it's great because you studied for FAR, you're good for this. If you study for this, you're good for FAR. So lots to memorize here. Just memorize our PEG ratio, price to earnings divided by growth. It literally is just this ratio divided by growth. And what are these? Well, I don't like to be theoretical, very high educational. I want to get down in the dirty questions, and we'll see some questions go through these. All right. As mentioned, watch out for tricks and irrelevant information. They will love to throw that at you. What's the price to earnings ratio? So I would read the question first. Next step, write out what the price to earnings ratio is. Well, it's the share price divided by earnings per share. Write it out like this, and then just go through and pick out the information you need. So let's find what's the share price, well, currently trading $25 per share. What's the EPS? Well, we don't need dividend. Growth rate, we'll probably need that for PEG ratio, but we are not at the PEG ratio yet. And annual earnings per share is $2.50 a share. Boom, 25 to 50 gives us a 10 PE ratio. All right, it's a valuation metric. A higher PE ratio is good. I mean, is it good? Is it bad? I mean, yes, a higher PE ratio is good, but that generally means the stock is more expensive. So you probably, I mean, this is not investment advice, but it's good to look for companies with lower PE ratios. Like, I'd much rather buy Apple at a lower PE ratio than it is now, because that means the share price is much lower. Now, the share price doesn't always reflect the value of the company, and as such, maybe I'm getting a good deal on the Apple stock. You see how the logic can just flow and flow. Whoa, same information except a little bit more added to it. What is the PEG ratio? First, I would write it out. And same information so far for the PE ratio. So PE ratio is still 10 from the previous question. We have even more irrelevant information. We don't need the shares outstanding, right? We still don't need the dividend. We used the 25. We used the 250 for earnings per share. That gives us our, again, a 10 P ratio divided by growth rate. The growth rate for earnings is estimated at 10%. That gives us a 100 times PEG ratio, PEG ratio, right? This is another valuation metric. There's just so many of them out there. Memorize it. You'll be fine. For most of these ratios, it's better to have a higher one. Again, I say that with a grain of salt. I mean, is it better for the company? Sure. It looks better to have a higher one. On the investor side, that just means the company's more expensive. Price to sales ratio, as the name suggests, it's price divided by sales. And we have the stock price divided by expected sales per share in year one. This is per share. Apples to apples. So this is price per share and sales per share. Wow, that was a little brain fart right there. This ratio indicates how much an investor paid for a share as compared to the sales that a company generates per share. A higher ratio indicates that the market is willing to pay more for each dollar of annual sales, just like price to earnings, same thing. The same thing. A higher ratio indicates the market is willing to pay more for each dollar of earnings, and the difference being earnings is net income, sales is just revenue. So same item there. Lower ratio means the opposite and can indicate a better value as an investment, as I mentioned, right? What's the numerator? It's the price. You want this lower to buy it. I mean, the company wants it higher, but you want it lower so you can buy it at a better deal. Just like by buying a house, I'd much rather the price be lower when I buy it. and sales. This is just how profitable it is, how much it is earning. Nothing crazy, nice, simple questions. What's the price to sales ratio? Write it out. Market price per share, sales per share. We have $10 of sales per share, $40 per share. Boom. Nothing crazy. You got it. It's $40 divided by $10. I'm just blowing through it because it's pretty simple. Just making the point that you should know the ratio and be ready to answer something. I mean, you could have a sim where it's got a bunch of these: price to earnings, price to sales, PEG ratio. You got to just bang them all out individually. They're not going to be difficult. It might be some tricks determining what the market price per share is, right? They'll give you the whole market cap of the company and then just how many shares are outstanding. And yeah, you'll have to figure that out. But nothing too crazy. What does this mean, though? It means that the investors will pay $4 for every dollar of sales that ABC company earns. And that's a nice way to break it down and think about it. I mean, it's how it is. You're paying $4 for every dollar of sales that the company will earn. Now, if investors are incredibly bullish on the company, if they think it's a super strong company to own, then they might pay even more per dollar of sales. And if they are not as confident in the company, or maybe, the overall market's just in a downturn, well, that could significantly decrease. Price to cash flow ratio. Oh boy, am I tired of just saying it's in the formula. It's price divided by cash flows. All right. So the price to cash flow ratio, also called price to cash flow ratio, or P divided by CF. So this is a ratio used to compare a company's market value to its cash flow. It is calculated by dividing the company's market cap, where this is the overall value of the company. It's the stock price divided by shares outstanding, by the company's operating cash flow in the most recent fiscal year, or the most recent 4 fiscal quarters, or equivalently divide the per share stock price by per share operating cash flow. You can do this for all of these ratios. It doesn't have to be the stock price, the earnings per share, and all that, right? It can be the overall earnings and the overall amount of shares. You can use, but as long as you're comparing apples to apples, oranges to oranges, right? You can use all of sales if you use all of stock, or if you're just using per share, per stock, then you want the per share amount of sales. Theory, a lower stock price to cash flow ratio, the better the stock is. This is the same concept as what we were seeing. It's better for the company to have a higher one. It's better for you as an investor. Well, for an investor, you want to buy it when it's lower, and then hopefully the price to cash flow ratio, just like all of these, will increase as time goes on. All right, and to be honest, I just used the same numbers as the price to sales ratio, and I just plugged it in. Same thing. That means that investors pay $4 for every dollar of cash flow that ABC company receives. That is investment 101, valuation, methods, models, right here. Again, this could be, we have $1 million of cash flow overall, and we have total market cap of $4 million. You could have something like that, and that would still work for our cash flow. It's a ratio, right? It's a percentage, a metric. Those are better than just adding or subtracting. Price to book ratio. Gosh, we're close to being done here. Don't worry, everyone. But it's price divided by book value per share, and this is a great actually metric to use if you're an investor. What is it currently trading for versus what is the book value? And this is much more in line with FAR, but on paper, what is the company worth? If you actually look at the balance sheet, people generally overpay for hype companies like Tesla. The market price, the stock price, the overall what it's trading for is worth a lot more than what it is worth on paper, than what it actually should be worth. That's how the market works. People think that Tesla is going to overall be much more profitable and a bigger deal in the future. A pretty big deal as is. So yes, they're paying more now for future positivity. The PB ratio, or price to book, measures the market's valuation of a company relative to its book value. The market value of equity is typically higher than the book value. So, because think about that for a second. If a company on the stock market is cheaper than what it's actually valued for on its books, then people are going to realize that and then buy the stock in the company. If a company has $80 billion of cash and the market cap is $70 billion, Well, I mean, then you could just buy the company for $7 billion, $70 billion, and liquidate all of its cash. So that, I mean, that's not to go down the rabbit hole of investing in stocks and company market caps, but yeah, I mean, typically you're going to have the stock market value of the equity is higher than the book value. The PB ratio is used by value investors to identify potential investments. Similarly, all these ratios, we want to know when you're using them, why are you using them, is it better to have a higher or lower one, and then be able to plug them into some examples. Here we go. Similar numbers, similar look again. We recently reported $30 of book value per share. So maybe on paper the company's worth $1 million, and we get our $30 book value per share during its earnings call. Stock currently trades at $40 per share, so that's $10 of premium. What is the company's price to book ratio? Price it's currently trading for in the market divided by the book value per share. So we get our price to book ratio of 1.3. That's our market price per share of $40 divided by $30 book value per share. It's the metric of our premium that we are paying for this company. All right, we are slowly getting closer to wrapping up. We've got some other valuation metrics and methods and all. Here is a good example of, is it better or worse to have a higher or lower of these? Now, spoiler here, it is actually better to have a higher of all of these ratios. For most formulas and metrics in BEC, we can compare how our company is doing against others, be it in valuation, performance management, working capital, or other areas. You would have seen this as well, depending on the order you're viewing this, in our working capital section, where we cover formulas such as the turnover ratios and cash conversion cycle. Lots there where it differs, right? It differs if it's better to have a higher or lower metric. But yeah, generally speaking, for the company, it's better to have a higher of all of these. But make sure you understand that, because that could very well be a sin. Generally, like, you could say that these are overvalued, that the higher one is overvalued. So per the PE ratio, our company we selected, ABC Company, is undervalued per the PE ratio, but per the PEG ratio, it's overvalued. I mean, generally in real life, these numbers would probably be more in line with each other, and these symbols would be more in line. I just made up numbers for the examples, right? So if all these metrics are showing it's undervalued, then maybe you want to buy it, but also maybe it's not worth it because it's got some problems going on. That's where you get into a little bit of analysis for understanding the company. Okay, we're still plugging along. I know this is super long and we've got a lot going on. I know you're staying strong, so take a break if you want to. For sure, take a break. You deserve it. Come back when you're ready, and we'll keep plugging along. It's just formula. Let's try it out. Formula. Let's try it out. So I'm keeping it as entertaining as possible. Maybe I could have it more entertaining. I could have a mandatory joke at the end of each section, but I'm not going to do that. I'm going to keep just ad-libbing what we do here. Well, the zero growth model. This is a valuation metric that tells us what the price of a stock should be. Now, I mean, oh man, if this always worked, then everyone would be a perfect investor. But it doesn't. It's a simple valuation formula that does not take into account real world factors, right? I mean, maybe a company is super profitable, but it's in a country that is currently at war with itself. I mean, I don't see anywhere here in this formula that says, oh, if country is at war, value company 25% less. Nope, doesn't say anything like that. It's an assumption of a model. Assumption of the model is that dividends are expected at regular intervals forever. So could you do this for Amazon? As of right now, Amazon does not offer dividends on its shares. So you could not use this for dividends, and it expects that dividends are at regular intervals forever. It doesn't take into account the increase or decrease of them. You see, it's super basic. Now, in reality, people, companies, investment firms, it's very much more, all right, they've got super complex models and formulas that take into account every metric, and they take into account the probability of war and the probability of inflation and all that. But luckily for you, you chose the accounting route, not the finance route. And here we are just going through these nice, simple formulas. So suppose a stock is expected to pay a 25-cent dividend every quarter. and the required return, as we know this is a break even, is 8% with quarterly compounding. What should the price of the stock be according to the zero growth model? Quarterly compounding, this is saying that we reinvest and compound quarterly. We reinvest our dividends and just plug it out. So our return, right, is going to be, we have 8% divided by 4, then divide 25 cents by what you get here, gets us stock price that should be at $12.50. So according to this model, the stock should be trading at $12.50. So if it's below the price, an investor should consider buying it. If the stock is above the price, the investor should consider selling it. Not telling you what to do. This is not investment advice. This is just the textbook, what you could consider if you're in this situation. The dividend growth model, we've got some more valuation metrics, right? How are we valuing a company? How are we getting that stock price the company should be at? Well, just throw some darts at at the wall and see what sticks. No, but we are going to use some more metrics. In this case, dividend growth model. Here's the formula. Definitely would memorize it. Something that's confusing in a lot of these formulas for a lot of people is the concept of D1 and D0, P0, P1. So what these are, anytime it's 1, that's the next year, 0 is the current year. So, what should the price be? Well, the price should be, right, the dividend now times 1 plus the growth rate. This would then give you D1, which is the dividend for next year. And this is growth rate. We'll go over that. But you see here how you can say it either way. You can say that it's D0, so the current dividend times 1 plus the growth rate. So we'll not to give you an example. We'll see an example quite shortly. And D1 is just the dividend next year. Same with P1 would be the price next year. Anything 1 would be next year. All right, let's see an example here. Well, how much should the stock be selling for? We read this question and we think right away, well, this is likely going to be dividend growth model or discounted cash flow, or there's many different ways to get the value of a company. Now, how do we know that this is dividend growth model? You can either write out a bunch of formulas that you know how to find out the stock price, or you can just read through and you see that, okay, these components all fit into our dividend growth model. It's just knowing all the formulas so that when you see a question, you are ready to answer it based on everything you've got stored away in your brain. All right, so we write out the dividend growth model formula, and let's start to identify what we need. So we just paid a dividend. This is our current dividend. This is D0. It's expected to increase its dividend by 3% per year. Okay, well, this is our growth rate, or increasing the dividend by 3% per year. If the market requires a return, so this is R is required return, 13% required return on assets, right? So immediately we're identifying this is the return, the required return or required return on assets. This is the growth rate. This is also the growth rate. This is 1, the number 1, and that's D0. Okay, so, but really this is just D1 together overall. How much should the stock be selling for? Awesome. We have all this information. Let's plug it in. So 45 cents times 1.03 gives you the dividend that will be paid next year. 13% minus 3%, this gives you the difference between the required return and the expected dividend growth rate, right? We're taking into account the growth on this stock. We're taking into account the profitability of it. And through this, we get an estimated stock price of $4.64, right? So we're taking into account the growth of it. We're taking into account the profitability of this stock, of this investment. It comes out to $4.64, plug and chug math formula. You'll get it and you'll knock them out. All right, now what about the next year? Okay, how much should the stock be selling for? Well, this is now an example of D1, D0. The difference here is Patrick Company is expected to pay a 3%, $3 dividend, pardon me, in 1 year. So next year, they're expected to pay a $3 dividend. This simplifies it significantly because now we just have D1. We just plug in D1 there and we're good. Right? That's a confusing point for a lot of people is the D1, D0, and I really don't blame you. It is kind of tricky. So this is all it is. I'm simplifying it for you. A lot of times it's presented quite complex. There's no need for that. So this is my job to simplify it. Required return 18, 4% growth rate. Plug those in. In this case, it's $21.43. Another plug and chug. Required return. What's the required return? We've seen this involving with break even, right? So the stock is selling for $12. Company just paid a dividend, and dividends are expected to grow at 3% per year. What's the required return? And here is our formula. It's honestly quite similar, but it is a different formula to memorize. Now, we have on the numerator D1 or D0 times 1 plus the growth rate. However, on the denominator, we now have the price, the current price, plus the growth rate. Just a little bit of a different formula, right? We're trying to determine what is the required return, or essentially what we need to make in order to break even. So we are taking into account the dividends up top, and that is just paid a $2 dividend. So we have to do 1.03, right? 1 plus the growth rate. That gets us our dividend for next year. We have our P0, which is the current price of $12 stated here. And then we add the growth rate again. That is going to get us to our total of 20.17%. Straight plug and chug again. What's the required return needed on this investment? Well, it's 20.17%. Perfect. Running through more and more. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.